What if I told you that the exact moment every investor on the planet is screaming to sell? History says that is precisely when generational wealth gets built. Welcome back to Smart Stock Sam, the channel where we cut through the noise and find the signal. And today we're going deep on something that's been keeping me up at night. We've got a full market breakdown covering the oil shock rattling global energy markets, a jobs report that shattered every expectation on Wall Street, a fear gauge flashing the most extreme panic reading in years, and right in the middle of all that chaos, one fintech giant quietly trading at a 40% discount while growing its earnings at a triple-digit pace. This is our SoFi price action deep dive versus current market volatility, and by the end of this video, you will know exactly why right now could be the best time to buy. Backed by real price targets, real technicals, and a real framework built on data, not emotion. Stay locked in. This one is going to change how you see this market. Let's start with the big picture, because right now the global economy is caught in a tug-of-war that nobody fully prepared for. On one side of the rope, you've got geopolitical fear. Oil has officially crossed $110 a barrel as tensions in the Strait of Hormuz continue to escalate. Brent crude is sitting above $105. When that corridor gets disrupted, the entire global energy supply chain tightens, and that tightening hits consumers, corporations, and central banks all at once. On the other side of that rope, the United States economy is actually holding up in ways that are genuinely shocking. The March jobs report just landed, and it didn't just beat expectations, it absolutely demolished them. 178,000 jobs added when the consensus was only 59,000. Think about that gap for a second. Analysts were off by over 100,000 jobs. That is not a miss. That is a completely different story. So what do you get when a roaring labor market collides with a massive energy shock? You get equity markets under immense pressure as confusion takes over, and confused markets always default to fear. And that fear has a direct consequence for the one institution everyone has been watching, the Federal Reserve. Here's where it gets critical. Look at the CME FedWatch data right now. There is a 99.5% probability, nearly unanimous certainty, that the Fed holds rates steady at 3.5 to 3.75% through the end of April. But it gets even more dramatic than that. There is a 78.9% chance of zero cuts through December, the pivot that every bullish investor was banking on for 2026. It's effectively been taken off the table. The energy shock has reignited inflation fears, and the Fed cannot move when inflation is being pushed higher by a barrel of oil. The market is not falling because the economy is terrible. The market is falling because the one lifeline everyone expected, rate relief, just got yanked away, and that creates one of the most fascinating setups I have seen in years. But before we talk opportunity, let's finish the full macro picture, because that blowout jobs number has a hidden layer that most headlines are completely skipping over. The headline print of 178,000 looks powerful, but when you pull back the curtain, labor force participation has actually dropped to 61.9%, its lowest reading since November 2021. And wage growth has cooled to 3.5% year over year, the slowest pace in nearly 5 years. What that tells you is that the headline jobs number is being powered by a narrowing segment of the workforce. Healthcare and construction are carrying the weight. The average worker's real purchasing power is stalling out. So this economy isn't running hot. It is shifting. It is restructuring, and a market trying to reconcile a strong headline number against weakening underlying trends is a market that gets very, very nervous. Now, fear has a measurement, and right now, that measurement is off the charts. The VIX, the market's official fear gauge, has spiked to 31, with an intraday high of 35.3. The CNN Fear and Greed Index is sitting at 15 out of 100. That is extreme fear territory, pure institutional-grade panic. When the VIX is at 30, the options market is pricing in an 8 to 9% swing in the S&P 500 within the next 30 days alone. Investors are paying enormous premiums just to protect their downside. Everyone is bracing for the worst possible outcome. And that brings me to the question I want you to hold in your mind for the next 60 seconds. What happens when everyone has already priced in the apocalypse and it doesn't arrive? Here's what the historical data actually says about moments like this one. When the VIX breaks above 29, the S&P 500 has historically delivered an average gain of 24% over the following 12 months. When the VIX breaks above 40, equities are higher 1 year later over 90% of the time. We are currently sitting in the zone between those thresholds, what I call the opportunity zone. The market is overreacting to headline noise. Implied volatility has decoupled from what the fundamentals on the ground are actually showing. Could we see more pain in the short run? Absolutely. Is it possible this sell-off becomes something deeper? Yes, and we're watching for that. But history is loudly, clearly, repeatedly telling us that peak anxiety is almost always followed by a recovery window. The question is whether you're positioned for it. On the technical side, the S&P 500 breaking below 6,500 has confirmed a bearish distribution phase in the near term. But look at the RSI, the Relative Strength Index, which has now dipped below 20. That means selling pressure is stretched to its absolute limit. Deep oversold territory. We have major support sitting at 6,300, and with momentum indicators this exhausted, the setup for a short-term mean reversion bounce is significant. The pain is not coming. The pain is already priced in. The chart is telling you the sellers are running out of fuel. Now let's talk about the company that sits at the absolute center of everything I've just described. SoFi Technologies. Ticker SOFI. While the broader S&P has been under pressure, SoFi has been punished even harder, down 40% year to date. And on the surface, that looks terrifying. But here's what makes this the most compelling divergent story I've seen this earnings cycle. The stock is being priced like a struggling student loan company. The business is executing like a vertically integrated digital bank at the top of its game. 35% member growth, 60% EBITDA growth, a record $1,020 million in fourth quarter revenue, 9 consecutive profitable quarters. CEO Anthony Noto just bought 28,900 shares out of his own pocket during this dip. You don't do that unless you genuinely believe the market is wrong. So why is the stock so beaten down? Because fear doesn't stop to read the income statement, and because there's a catalyst coming that Wall Street hasn't fully priced in yet. SoFi is launching what they're calling big business banking. Enterprise-grade banking infrastructure built for the 24/7 global economy. Legacy banks operate 9 to 5, Monday through Friday. In a world where transactions clear across time zones around the clock, that model is simply obsolete. SoFi's enterprise solution runs 24/7, 365. It is API-driven, fully FDIC-insured, and it includes instant fiat to crypto conversion and settlement. CEO Anthony Noto has made the point directly. To be competitive in today's economy, you have to be always on. Legacy institutions are operating on infrastructure built decades ago. SoFi is building the digital jet engine that replaces it. The architecture powering this is what I call the Stablecoin Sandwich. A business makes a deposit into SoFi's regulated national bank. That deposit is converted into SoFi USD, a fully reserved stablecoin, and then moved instantly across Solana and Mastercard network rails before settling back into fiat on the other end. Institutional-grade speed, regulated perimeter, no forced exposure to crypto volatility. This is programmable liquidity, and it frees up billions in working capital for their corporate clients overnight. This isn't a feature. This is a new category of banking infrastructure, and the institutions signing on to this architecture are not small players. We're talking Mastercard, Galaxy Digital, Fireblocks, and BitGo. These are Tier 1 names with Tier 1 due diligence. SoFi is positioning itself as the bridge between traditional finance and Web3. not a participant in that ecosystem, but the operating system running underneath it. That is a fundamentally different value proposition than anything the market is currently pricing in. At the same time, SoFi just secured $3.6 billion in new loan delivery commitments from a global bank, an insurance group, and a top 5 asset manager. This matters enormously for how you model the business going forward. In the past, 65% of SoFi's revenue came from net interest income, which means it moved in direct proportion to rate changes. Going forward, 70% will come from non-interest fee revenue. Capital-light, rate-insensitive, high-quality recurring revenue. They are actively reshaping their earnings profile from a rate-sensitive bank into a technology platform. That is exactly the type of transformation that gets repriced by the market, once the market decides to stop panicking. Now, I always give you both sides. The bear case on SoFi is real, and you should know it. Muddy Waters published a short report alleging unrecorded debt and risk tied to a JP Morgan deal. There are also rumors circulating about SoFi being excluded from the SpaceX IPO process. Short seller scrutiny at this scale is what keeps a stock pinned down, regardless of fundamentals, and it's a risk that deserves acknowledgement. But the counterweight to that is the fundamental track record, 9 consecutive profitable quarters, and a CEO buying nearly 29,000 shares with his own money. Insider buying at scale during a short attack is one of the clearest conviction signals you can observe in public markets. Before I share the Wall Street targets on SoFi, I need to be fully transparent with you. Everything covered in this video is for informational and educational purposes only. Nothing here is personalized financial advice. I am not your financial advisor, and this should not be treated as a recommendation to buy, sell, or hold any security. Markets carry real risk. You can and should do your own research, consult a licensed professional, and never invest more than you can afford to lose. My goal is always to give you the best data-driven framework I can. The decisions are always yours. All right, Wall Street's current consensus price target on SoFi sits between $24.96 and $25.91 against a current price of $15.85. That is a range of 57 to 63% upside from where we are right now. The high target on the street is $33, more than 100% from current levels. Even the hold ratings carry price targets, implying substantial appreciation. When you stack a 60% EBITDA growth rate against a $20 billion market cap in a fear-driven sell-off, the math simply doesn't support the bear thesis over a 12 to 18-month horizon. So here's the Smart Stock Sam bottom line on everything we covered today. The energy shock is real, but the labor market is providing a fundamental backstop. We are not in economic freefall. The extreme fear reading across the VIX and the Fear and Greed Index is historically one of the strongest long-term accumulation signals that exists, and SoFi is trading at a steep discount to both its fundamentals and its future potential, while quietly building 24/7 banking infrastructure that threatens every legacy institution on Wall Street. Volatility is not the enemy. Volatility is the price you pay for the opportunity. The data is clear, the floor is forming, and the technology is ready. The only question left is whether you're following the fear or following the fundamentals. Now, I want to hear from you. Here's a question I'll leave you with. Do you think SoFi can hold that 6,300 support level next week, or are we heading for another flush before the real recovery begins? Drop your answer and your price target in the comments below. I read every single one, and I'll be responding this week. If this breakdown gave you value, please hit the like button right now. It genuinely helps this channel reach more investors who need this kind of data-driven analysis. And if you're not subscribed yet, hit that subscribe button and ring the notification bell so you never miss a market update from Smart Stock Sam. I'll see you in the next one.